Awesome.
All right. Hello, you trader nerds. How are you? Hope you have a great day. We are honored today to have our buddy, Dr. Jim Schultz with Tasty Trade back with us today. Dr. Jim, what an honor, sir.
Man, what's going on? We're doing this again. I feel like we just did this a couple weeks ago. I mean, it wasn't that long ago. Was it like over the summer? When was it?
It was over the summer when we did it.
Okay.
And we were talking with you at the end of our session about the 1-1-1 strategy that we had been implementing, and you were kind of excited about that. But Dr. Jim, I got to tell you, it's been a wonderful couple of months because we have made some discoveries that we think kind of solidify the strategy and what we're doing. So what we wanted to do today is kind of share with you what we're doing. And because you are the founder, not Jim Cramer, of the gimmies and the gotchas, we thought we'd have you come in and,
sure.
and give it a good look and say, Bobby, here's where you're missing it. Listen, here's where this thing's going to cause disaster and ruin, and you're going to blow out your account. So that's what.
No, let's do it. Yeah, no, let's absolutely do it. Is there a way? I'm trying to get the chat up. Like normally we have questions coming in, right? And like I can see those.
You don't see those?
No, I don't. Has there been any comments yet?
Not yet. But
okay, well maybe that. Mike just sent in. I got it now. Thank you, Mike. And thank you, Ed. That's great. Okay, perfect. Okay, I got it. We're all good.
Good.
Okay, cool. No, you take it away, man. And I'll try to spot the gimmies and the gotchas as they come to me.
So spot the gimmies and the gotchas. So very simple. Here's kind of what we do. Let's start from the 10,000 foot view, right? What we do every day. So Dr. Jim, we come into our account every day, and we are big users of the spreadsheet. So we will record our net lick that tells us our daily profit and how much running profit and loss that we have. And then we give a big top of the hat to Tasty Trade and their research, and we record our Greeks and ratios here, which are kind of cool. So those are pretty simply, we limit our deltas to, and this is volatility weighted deltas as well. So we don't want to get too high in the deltas. So this kind of changes as the VIX goes up, or we're able to use a much more conservative delta, which is 0.0015 times our net lick. So we just kind of don't want to get above that area so that we're effectively delta neutral. So we don't want to get too high. We don't do it too big. So we don't want to be just totally bullish on the market. But as you well know, markets go up in the long term, and that's that we do maintain usually a little bit of positive delta.
Don't tell Tom. Don't tell Tom that you said that.
Exactly.
Like we'll edit that out of the recording. We'll get that off the record. Don't worry.
we'll turn it down. Exactly. All right, Dr. Jim. Then we actually do go by the theta metrics that Tasty recommends in keeping a minimum of 0.1% of our net lick in theta, and we never go above 0.5%. And what I also did, Dr. Jim, is I made this based on VIX as well. So whatever the VIX is will tell us the maximum that we can go in theta as well. Because a lot of people don't realize, and you well do, I've heard you say it, theta is a measure of risk. So we don't want to have too much theta. So we try to keep enough in the tank so that we have the 0.1% that Tasty recommends. We never go over 0.5%. And the amount that we can use is certainly based on volatility. So when we put in our deltas and our thetas, our spreadsheet will tell us, hey, Bobby, you're too cold. You don't have enough gas in the tank to run the engine. So when we do have enough, it turns green so that we can quickly say, hey, we've got enough theta in the tank. Oh, here it is. It tells us our max theta based on this VIX level. So if we were to change VIX to, let's say, 40, that 0.3 is going to go to 0.5. So as far as our maximum theta. So I just want to show you that. And then the third metric is we go by the Tasty metrics and mechanics of buying power. Now, let me preface it by saying this. We are trading futures and futures options. So we use span margin. We realize that span margin is that beautiful seductress sitting at the old bar, right? She is gorgeous. She looks great, but she can get us in a lot of trouble, Dr. Jim. So we know the issues with span margin. It's low initially. It can increase on a dime. We understand that, but we do use the maximum buying power based on volatility. So same thing, right? With a VIX at 22, we can use 35%. If we change our VIX here to 40, our buying power could go up to 50%, and then that changes green because I'm at 42%. So we use our buying power metrics established by Tasty for our account. So basically, as I go into my account and look today, it says, hey, you got enough gas in the tank, but you're using a little more buying power than you should be. You should be at a max of 35. Your deltas need no adjustment. Everything looks good other than, buying power. And then we have to ask ourselves, are we comfortable with the risk? And I was yesterday, but at the same time, this tells me, Dr. Jim, to not put on another trade today. This tells me, hey, Bob, slow your roll. We don't want to take too much risk. We don't want to layer in too much risk. You got enough theta. Buying power is a little elevated. Everything's good. So do you have any questions about this so far? Kind of where we are, the three metrics that we use? It's delta, theta, and buying power.
No, well, first of all, that's a really, really solid looking piece of work that you have there. That spreadsheet is pretty awesome. I don't really have a question. The only comment that I would have is, so your buying power, so that column S, your max buying power, and then O, the buying power used, that is based off of span margining, correct?
Yes, this is the span margin that we're using. Yes.
So you're actually like, so if we were to remove the span margining and you were to go into equity options, let's say, those numbers would all increase potentially significantly, is how I'm understanding that.
Correct.
Okay, so you just, and it seems like, I mean, we've met before, and obviously everyone that's listening to, this little webinar is very clear of the concept, and we're dealing with, experienced traders here. So you all just have to understand what you're signing up for here, right? Like, you are a lot larger than those numbers might suggest, as we typically think of size. Because generally when we are talking about size, we are talking in terms of equity options, more standard buying power. We're not talking about span margining. We're not talking about portfolio margin. Like, these are very special things and unique things that you can certainly use, and you can use them to your advantage, but it does cut both ways, as you kind of alluded to earlier. So you just have to be aware of that. That would be the biggest gotcha that I see right here in terms of how this is set up.
Great. And you bring up great points about that. And I probably should say it more for those of you that are not accustomed to trading using span margin. She can get out of trouble in a heartbeat, right? She can get really big. And I think if we were to look back over what we've done this year, I mean, there were times that we got up. I mean, most of the time we're fine, right? Every now and then we get elevated. We went up to 50% back in June. In the smaller account, we were up to, I think, 97%. But in the IRA account, most of the time we're good at saying, hey, we're too, got using a little bit too much buying power. We can either take a trade off to reduce that. We could sell a micro future to reduce that. So there's things that we can do to do that. You just everyone needs to ask yourself, am I comfortable with that risk? And so,
that's right.
Yeah. And so I'm comfortable with this risk at this time. So, all right. So that's our 10,000 foot view, and great comments by you, Dr. Jim. I appreciate that so very much. So then if we kind of go into the individual trade, let me just kind of tell you what we do. Let me explain how I view this little 1-1-1 trade, because it's kind of cool. We used a football analogy last time, Dr. Jim, to talk about this, but since Alabama is not going to make the playoffs this year, we've switched.
But Michigan is. So we can still use that analogy. The analogy has been saved because the University of Michigan is going to make it. You don't have to worry about that at all.
Hey, I was really proud that that Michigan whooped Ohio State, though. I thought that was beautiful. I love that. All right. Well, so let's kind of, I'll go with the chess analogy first. So we do a put debit spread, right? Put debit spread, and the put debit spread is composed of a short option and a long option. So we know what that is. So let's go put these little guys here. All right. So we got a negative and we got a plus. We got a long put and we got a short put. So that's our put debit spread. Now in chess, this in chess, these are the pawns, right? That kind of protect our royalty down below. In football, these are these big 350-pound offensive linemen. The only problem is they are rookies on their first day. They give us no protection really to the downside at all when they first come home. Matt says we are a women's soccer school. For real, Matt? You talking about Alabama? Yeah, okay. So these are the pawns that start out. But the cool thing about our pawns, Dr. Jim, is they get experience. So after several days, our pawns become bishops. And then after a few days that these things are out there, they become knights. And finally, they become rooks. So these things get stronger as the days go by, right? So the put debit spread matures. They become a little bit stronger as the days go by. Now, all the time that our little put debit spread is getting stronger, becoming a pawn and migrating to a bishop and knight and the rooks, we're putting more of these things on time and time again. And we're putting these things on, Dr. Jim, don't tell Tom, but we're doing our trades closest to 60 days to expiration.
Mm-hmm.
Okay, so that's where we're putting on put debit spread. And we're putting these on where we can buy these for $10 in the micro e-minis. We're doing them for $10. We're buying $10. So that's our put debit spread. But then we've got to put some royalty behind them. So what we're doing in this volatility, instead of it being a 1-1-1 trade, we're actually selling 2 naked puts way off behind them, so that our total credit received is at least twice the amount of the debit that we paid. So we would sell these puppies out and we'll get, say, $20 for them. And this is our king and our queen. Now, our king and queen are really unprotected when we first put them on because these things are just pawns. So they're unprotected, but at the same time, this is our profit driver. These are the ones that give us the theta. They're the ones that give us the theta decay. They're the ones that are contributing to our underlying profit. They become less important as the days go by. So what I mean by less important is they will burn off to a point that, they're just really not worth anything under ordinary circumstances. As these become stronger, these become they decay. The king and queen, she's anorexic. He's got problems himself. So they just become to a point that you can actually just kind of take those off at some point. And what we were doing before, Dr. Jim, is we were managing these things as an entire trade. So if we put on this 1-1-2, when this thing got to like 65% profit, the entire 3 components, this and that, we would take the entire trade off. Here was our big discovery that we wanted to share with you. Dr. Jim, these trades were absolutely made to go closer to expiration, including the naked component. So with that being said, we're taking a lot of our kings and queens to expiration. So that's kind of heresy in the tasty world, right? But you go, wait a minute, Bobby, you can't do that. You just can't do that. We need to take them off at 21 days. You need to take these off at 50% profit. We need to do this. But what we found is we're getting such great protection from the put debit spreads and their ceremonial increase in their responsibilities that these things are able to go to nothing. Now, we can close them, and we'll go through it today and just let you look at it. But this is what we wanted to show you as far as the gimmies and the gotchas. So you understand the whole concept. Why don't we look at the trade in tasty works, okay?
So hold on. Let's hang here for just 1 second.
Sure.
Just a couple of comments. So number one, I don't even know how to play chess. I have no idea how to play chess.
So I understand all that time explaining something that now you're
no. I understand the pieces.
Yes.
I understand the pieces slightly. And this analogy, this is outstanding. So I may ask you at some point in the future if I can borrow this analogy. Because I may even ask you right now if it's okay. If I borrow this. It is so good. It is so good because, like when you were talking about pawns and bishops and knights and rooks, and the put spread, maturing. I'm like, that's such a good word to use, because what a lot of people don't recognize in the world of options, I mean, new traders, it's information overload. Like, all of it's brand new. They don't understand really anything. But one of the things that people are oftentimes confused by, this is outside of the 111 or the 112, but just more generally speaking, is they'll put on a long debit spread, a long vertical spread, and the stock will move in their favor, and yet they won't see the profitability that they would expect at that point. And the reason why is because it almost happened too quickly. It hasn't had a chance to mature. You haven't given that extrinsic value a chance to come out of that spread or to build up in that spread, depending on which side of the market you might be. I guess it would be always extrinsic value coming out of the spread. But thinking about pawns, bishops, knights, and rooks, I'm like, wow, this is so good. And then you've got the royalty as the driver. Man, I really like this a lot. So one quick question though. So you're buying this spread for $10. If memory serves me correctly, this is oftentimes like a 50-point wide spread. Is that right?
Yes, 50 points wide is generally what we're doing. Some people are doing 30 wide. So I do 50 wide. So it costs me $50 in the micros to put this on.
Sure. Yeah. Okay. Yeah. And so when I think about this, and then we can segue into looking at it inside of Tastyworks. But so when I think about this, and I think about the discovery that y'all made in terms of needing to be closer to expiration, I'm not surprised by that at all. I'm not surprised by that in the least bit, because this strategy is very much like a ratio spread. Now, it's a little bit different, and the way that you're kind of setting it up is not exactly the same, but it has a lot of the same characteristics. Well, one of the things about ratio spreads is if you really want to extract all the juice out of that ratio, you have to hold it close to expiration. You have to take that thing all the way down to the wire. Otherwise, you're going to leave juice on the table. Now, you may have a strategy such that you're okay leaving juice on the table. That's perfectly fine. I mean, that's what we talk about all the time with 21 days to go and things like that. But this is a very unique, special strategy that's serving a very specific purpose. And to that end, in and of itself, I think holding to expiration could be exactly what the doctor ordered. So I'm not surprised that you all discovered that. And, I kind of have a feeling and a sense of where this is going. And so I'll let you kind of lead us through the forest here today. But I think I'm almost definitely going to give this, my stamp of approval, as of course, we outline the gimmies and the gotchas.
Doc, I got to say something. You're like getting me all pumped up here. I'm so excited. I'm very excited.
Man, I'm pumped up about this chess analogy. I'm pumped up about this chess analogy, and I didn't even know. I'm also pumped up about this little Microsoft whiteboard little ditty that you sprung on me. I didn't even know that existed. And so I'm like, man, I'm about to start breaking this out for some of my videos. I'm like, this is great, where you can just bring that up and start working it out. Like, that's awesome.
Yeah. So that's awesome. Okay, so Dr. Jim, I'm going to go through exactly what we do. I'm going to pretend that we're doing our daily session. And I appreciate your indulgence if that's fine. And I'm just going to show you what I do. Okay. So what we do is we go here. Today's the 30th, right? Y'all, we hope we get to play some music for Dr. Jim. He'll like this. So what I do is then I'll go and I'll get my net lick, right, from my Tasty account. Oh, here it is. So I try not to show it because I got in trouble one time for showing it. But if y'all will believe me that my net lick is 36,827, which means we had a profit, Dr. Jim, overnight of 88.15. And when we do, we play this song.
Well, we're moving on now. We're moving on up to the side. To a deluxe apartment.
And you're bringing me back. You're bringing me back to my childhood.
Wasn't that great? So
I mean, I remember the Jeffersons as a little guy. And I mean, that was kind of the generation before me, but yeah, I remember.
It's good stuff. So then, Doc, after we've done that, what we do is we record our delta and our theta. So 37 and 83, go back to the spreadsheet, 37, 83, kind of let you see how it works, 37, 83, and so what's the VIX today, y'all? We'll say it's 22 or so, 22, 23. And then we'll get our buying power. Buying power usage is 15,920. About the same as yesterday. It may not have updated. That's fine, but we'll just go with this. So we are at 43%. We're a little heavy. Ordinarily, we would not put a trade on today. And, but our theta is about, it's really good. And our deltas are non-existent. I mean, we could certainly go up to 74, so we're fine. So on this day, I would go, okay, Bob, you're not going to open anything, but I wanted to go through it and at least show Dr. Jim how we put on the trade. So here we go to the macros. We go to the table. We go closest to 60 days without going over. Long put vertical. We make them 50 wide. And then Dr. Jim will see our problem that we've talked with the developers about. As we move these down, they will, this will get hung here, right? So what's the 3550 won't move as I move it down. So I'm like, oh no, I gotta move that manually to get 50 points. And what we're gonna do is we're gonna take these down to where they're, right at $10. So let me build it really quick. Like that one's 1375. Maybe quicker for me just go down this way. Go down this way. I'll tell you what I'm going to do. Just for this, and since we're not going to actually put on the trade, I'm going to go to 62 where we can just build it quicker. Long put vertical, 50 wide. Move that down. And so we're going to move that down to it's about 975. What we found is if we move it down to the 975 area, we can bump it up a quarter and we get filled most of the time. So this is where we put this trade, right? And get it for around $10. Then we're going to go down and sell two at around $10. Now I'm a greedy capitalist, so I normally always try to get a little more. So we'll go maybe the 3,300, and then the 3,300 will sell two of those. Okay. Yeah. So there's our 111. So it looks like it's saying we're going to get a 1275 credit. Buying power on this thing is $726. Max loss if it goes to zero, max profit if it goes into that little profit tent, 98% probability profit. So I just wanted you to see the trade, right? You understand that fully. I know that you do. So kind of let you see now what the curve view looks like. Let's see if we can just isolate the trade. Dr. Jim may have to help me do this. He's much better on the software than I am, but
I'm not though, especially not the curve view.
okay.
No,
So
I live on the table view almost entirely.
okay, so let's just show you this actual trade here.
Right.
Get those, and then so here we go, Dr. Jim. It's just a beautiful trade, right? So if we go up or stay the same, we're going to keep the credit that we sold this entire thing for. If we go down into this area, we could experience, some pretty tough losses in the early stages as our put debit spreads are pawns, but toward the end, they become incredibly strong, right? To where we could go, hey, go down, baby. And, you make a large profit. And then way down here, is where you could have some issues if we go, way down below the 3290 area in there. But we're all comfortable with that risk. We can't live and take no risk. So this is a pretty cool thing. Now, here's the cool part, Dr. Jim. You ready for this? Let me clear this out and let me show you our existing positions so you can see what a campaign of these things look like. So now let's go back and get everything on here. Look at my soldiers and look at this army. We are advancing, right? We're looking to advance over the profit. We're currently here and we're totally in the profit zone and we're looking for a pullback, Dr. Jim. We're looking, even though we got positive delta, we're looking for the market to come back into our profit tent. And look, this profit tent has already grown. We can do the Theo where it is and the expiration line. We got this huge profit tent to the downside, and you see our little magic mountain. We call this a whale, and I normally draw the whale, with the tail there and the little spout there and the little eye there. So we got this nice profit hump all the way down to, look at this, 3180, 3145, and we're at 4,000. Now, unfortunately, with Tasty Works, we're unable to show you all of our positions because we can't get this expiration. Like if I were to click expirations, this is our closest expiration. So this is our 0 or 1 day options that are expiring, our 16 days. That's just our today and 16 days. So then we've got under the positions tab, we have the other expiration. And here's this one. So this is our 30-day options and our 51-day options. So I'd have to show you kind of two different. So let's go to the MESH3, which will be our 30 and 51 days. And that looks like this. So I can't show you both of those together, but you see we've got warriors built up here too, right? Protecting the royalty way down to the end. Now, if we go back to the positions tab, let's go to those options that are expiring today. So we have a lot of these naked puts, our kings and queens down here of the 112 that are expiring today. Where are they? They're at the 2,800, 2,900, 2,950. I see no reason at all to take these off. Now, one thing that we're talking about, Dr. Jim, is maybe we take these things off at, I don't know, 99%, 98%. You know, I mean, they've done everything that they could. So maybe we take them off at 7 days. So we don't have all of that done, but it's basically, are we comfortable with these things going all the way to the end? And when you've got something at a 2,800 expiring today, I don't know. We just felt real comfortable taking them into the end. What do you think, Dr. Jim?
Yeah. So, wow. I mean, so that's great. So a couple thoughts popped into my mind. So number one, so you had kind of mentioned a few minutes ago when we were on the whiteboard, you had kind of mentioned like, take it, you started off taking these things off as a package, like looking for 65% of the whole thing, and then you take the whole thing off. So right now, you kind of just alluded to, holding the naked short puts, the royalty until the end, potentially to get all of the profit from that. What about the vertical spread? So what is the strategy for the vertical spread? In terms of, is the strategy to hold that to the end too, because it's building up all that maturity, as we like to say now? Yeah.
So we let those go to the end, unless, say, for example, if it was at the put debit spread was at 100% profit, at the end, and there was a likelihood that price was going to go up out of that little profit tent to the upside, and get us out of there, then we may close it. But the plan on most of those is just to let it go to expiration.
Yeah, because I mean, you take a situation like this one, just like your short puts, all of those are out of the money. So all of those are going to be gone anyway. And you're just going to be left with that net credit that you picked up at the beginning. Okay. That makes a lot of sense. My second question and or comment would be this. So in thinking about how you guys set this up, so I love the way you guys set. I mean, I loved it when you first introduced me to this idea a couple of months ago, and I love it all the same today, maybe even a little bit more, because it's getting refined, it's getting polished. Like, it's really cool to kind of see these things come to life. My other question or comment would be this: when it comes to setting these up, and you guys have probably already had conversations around this. So I'd love to hear, your thoughts or some of the guys and gals that are on today, some of their thoughts. What is the objective with these? Because you have two things happening at once, right? So you have the credit that you collect on entry. That is the net differential between the naked options, the royalty, and then the pawns, right? The put spread. So you're picking up, some net credit differential. So when you're thinking about your profit objectives for the year or for the quarter, which you guys are clearly doing because you have that spreadsheet and you guys are so systematic with how you're going through all of this. I'm sure you guys have had these conversations. So when you think about your profit objectives for whatever time period you might be looking for, are you including that in those profit objectives? Like, are you relying on these to contribute some, albeit small, but some positive amount to that end goal? Because if you are, in my view, that's going to lead you down one pathway forward through the forest, which might be very similar to what you're doing right now. But if, however, you have all of these other positions, right, that are not the 111s and the 112s, that is more of your standard, the strangles and the short puts and the ratios and the iron kind of whatever else you're doing, that's kind of your core portfolio. If you're kind of thinking, all right, we have this core in place, that the task of that core is to get us to our profit objective. The specific goal and objective of this, the 112, is to protect us to the downside. It is not really anything that we're able to achieve from a net credit differential. It's all gravy. It's all bonus. It's all just extra icing on the cake. If that's the case, then in my view, that's a slightly different pathway forward through the forest, because what you could experiment with, and I'd be willing to bet you guys have already thought about this, experimenting with, because I mean, I'm looking at the whale, I'm looking at the soldiers. I'm like, man, that is a ton of, like the image I have in my head is you're playing Risk, right? I mean, we've all played Risk, right? So the image I'm having in my head is you're playing Risk and you've got all the armies like stacked up, like on that first little, country that's protecting Australia, where, you got Australia to begin the game. You're getting your 2 armies every round. Like you've got a huge, just force, just formidable object that's protecting that area. And that's exactly what I see right here. So that's very good. But I'm like, man, we could potentially make that even stronger. We could potentially make that even more formidable by maybe widening out that put spread, by maybe, going for even, but so you're reducing your credit. You're reducing that net credit differential on entry, but you're using that credit to maybe boost the debit that you pay so that you can widen that out even more. Because effectively, it all goes back to this. You guys even said to kick things off today, you're slightly bullish on the market, right? So what are you most exposed to? Well, you're most exposed to a big down move. Well, okay. If your core portfolio, the strangles, the iron condors, the verticals, the short puts, whatever, the long stock, covered calls, whatever you guys are doing, if all of that is going to do very well in, an up move market, a strong up move market, a mild up move market, a stagnant market, if it's all designed to do well in that market, well, then maybe we look to take that credit differential from the 112, maybe exhaust it entirely, right? Again, just thinking out loud here. Maybe we exhaust that entirely. So we lose all that profitability if the market rallies, but we don't really need that because we have all the other forces, the core portfolio that's going to do that. But instead, we just build an even more formidable force on the way down. So that's my initial thought here. So I'd be curious to hear if you guys have kind of thought about that or tinkered with that.
Yeah, great discussion, Dr. Jim. I ran this by Tom the other day. Just gave him a short synopsis of what we were doing. Here was Tom's thing. He said, Bobby, he said, in a bull market, in a raging bull market, the put debit spreads are going to be a draw against your returns. And I agree with him. And what we found, Dr. Jim, is it's difficult for us to keep enough gas in the tank when the market is going, it's just gangbusters. If the market's going up, you got these big days. I'm a little cold on being able to put enough theta into the engine to keep it going. So, but here was the great thing. In the month of October, the market was up 7.99%. We were up, I believe, 5.65%. So in a raging bull market, we may underperform the market, but what we will do is in a grind down bearish market, we should substantially outperform the market. So if we could do 5.65% when the market's making 10%, boy, I think we're all still happy with that, knowing that we've got something that if we were just entirely in SPY with our positions, if we were entirely just holding stock in SPY, that we've got a buffer that they would not have. So I think we're able to give up a little bit of returns in a bull market for the anticipation that we've got a little bit protection to the downside that we wouldn't have if we were entirely in the S&P 500. I do like your comment too about, hey, and people have been experimenting with widening. I think some people may do 100 wide on that, and I think that has merit. Another thing that, Dr. Jim, I'd be interested in hearing your thoughts on is this. Some people are even saying, look, we actually should put the put debit spread in the 30-day cycle or the 60-day cycle and sell the naked put in the 60 to 90 days. So we're putting the royalty out farther where they're a little safer and putting the put debit spread a little closer to expiration so that it becomes a little stronger quicker. Yep. So, and those are some things that we're going to experiment with as well.
Yeah, so that's really interesting to me. So that second comment is very interesting to me. I kind of had a similar thought in my head too. It just a lot of that I think depends on, because there's gimmies and gotchas, right? With the delta strength and theta strength and all that stuff. And so a lot of that comes down to, I guess, how active you want to be. Now, you guys and your group is obviously, quite active. And so you guys are kind of on the Shooter McGavin end of the spectrum, as I like to say on my show. And so understanding that, I think having a little bit, being more in the 60-day makes more sense than having those short puts in like the 90-day. They're just going to sit there. They're just going to collect dust. There's not really going to be too much to do there. And so I think turning things over a little bit more quickly kind of makes a little bit of sense, but I'll make a comment on what Tom said and also what you guys are kind of thinking in terms of your returns per month and all of that stuff. And yes, I mean, I would completely agree with your analysis and like take your October results, for example, market up 8%. You guys were up 5.5%. I mean, that's a terrific month. That is a terrific month. Because you also, of course, have to take into account, as you referenced, all of the downside protection that you had built in. It's no different than having an insurance policy that it's like you never had to use it, but it was there the entire time. And so you can't just forget about it like that. That obviously factors into the 5.5%. And so, yeah. So when it comes to returns and when it comes to the profitability that you guys are able to achieve, if you guys like where you're at, then I don't really see any major changes to what you're doing, right? However, the one change I would consider exploring is widening out the put spread, maybe going even further out with the put spread. So going even further out of the money to build in even, more crash protection, potentially, which that's obviously going to lessen the cost if you go further out, but it's also going to shrink that distance between, you have that nice buffer right now where the put spread ends and the short puts begin, right? You're going to potentially shrink that distance a little bit if you start pushing that put spread out, but it's going to reduce the cost. So again, it's gimmies and it's gotchas. I don't know that it's necessarily a better or worse thing. I think it all kind of depends on, once you get your campaign underway, that's an excellent use of the word campaign, by the way. Once you get your campaign underway and you kind of see how the whale is starting to form and you start to understand, okay, my holes are here, my risk is here, I'm a little bit weak there, then maybe that's when you start to move away from just being fixed on a $10 static put spread cost, and you allow a little bit more fluidity in that number. Very similar to how you have some fluidity with your theta numbers and you have fluidity with your delta numbers. And so rather than having it be $10 on the nose, you might want to experiment with kind of some range, right? To where maybe you go as cheap as, $5 or $6 or $7, in exchange for having it be further out of the money. But the other thing that I'll say, as far as, the VIX being lower right now and not being able to put on as much theta, I agree. I agree with all of that. But something that you might want to consider toying with, and I did a segment on this. Man, I did a segment on this. This was like back in like 2016. So this is like when I first started at Tasty Trade, right? It's probably still in the archives if they haven't deleted it yet. But the name of the segment was The Timeless Sale of Premium. And the basic idea that I was trying to promote in that segment was selling premium works really well in high volatility environments. There's no doubt about that. But don't forget that selling premium works pretty well in all environments. So even in low volatility environments. And we actually just went through, 2017, most of 2018, 2020, obviously the COVID crash was a little bit crazy. 2019. These were all very, very suppressed VIX environments. And so selling premium in those environments can be profitable. It can be profitable as well. It may not be as profitable as higher volatility environments, but since the context of this entire webinar is kind of just very gently bending the Tasty Trade rules a little bit. Let's bend them a little bit more, right? Just a thought experiment, like nothing official, nothing in writing, but it's like, hey, maybe I put a little bit more theta on when the VIX is a little bit lower so that I have a little bit more gas in the tank. If I'm willing to expand my downside protection by, widening out the debit spreads and all those things. Again, as you guys clearly do a very good job of doing, you're thinking about all these things as a puzzle, right? And you have one piece to the puzzle and it's like, all right, if I remove that piece, how does that change the rest of the puzzle? If I put in a new piece, how does that change the rest of the puzzle? And you guys do a really good job of that. And so, that would be another thought that I would have. Again, just experimenting with maybe pushing up that theta ever so slightly to get a little bit more gas working for you, understanding what you're signing up for, that if volatility expands rapidly, like, yes, you'll be worse off than you would have been had you had less theta on, but If you run into a 3-month, 6-month, 12-month stint where volatility just stays low, you're going to be better off for having done that. So again, just something to think about.
Yeah, great suggestions, Dr. Jim. Hey, let me get your comment on this as well. Evan in our group is experimenting with this on the call side. I have experimented with it too, but my soldiers were all on the left side, and I only had weak soldiers on the right side. And I got to tell you, it was just difficult, right? Because you can't get far enough out on the naked components of the thing to do it. But he's been successful with it so far, but he's initially just starting it. But you could actually put this on both sides so that you've got a well on the left side and a well on the right side. I just decided at this point I don't want to focus on the call side. Any comments on doing this on the call side as well? Because
Yeah,
it just made it difficult.
Yeah. Well, the skew is going to make it difficult. And also, I think that really comes down to what is your overall bias in the marketplace. And so again, like early on, you kind of said, okay, we are generally bullish in the marketplace. You may not be as bullish as I might be, but you have a generally bullish bias. And so understanding that, I think, is very important. And I think one of the mistakes that a lot of traders make is they flip-flop around. Like they're bullish and then they're bearish and then they're neutral and all that kind of stuff. I mean, it's one thing to scale your deltas because of, some event or Jerome Powell, whatever, like that's fine. Like I understand wanting to have maybe more directional exposure at one point, less directional exposure at another point, but I really don't like, you're bullish one quarter, then you're bearish another quarter, then you're this, then you're that. I think you can run into trouble and you end up chasing your tail a lot because again, and if, you guys watch my show, Bobby, I know you watch the show all the time.
Absolutely.
But, one of the things I talk about on a regular basis is marketplace cyclicality. And it's not something that I can necessarily prove with empirical findings or hard stats, at least not like what we've shown on Tasty Trade per se, but the marketplace is cyclical in my view, and no one can really convince me otherwise. And I'm not trying to be like a stick in the mud and just saying I'm not open to change and I'm not open to new ideas, but it's really hard. It's really hard to kind of move me off of this stone because I'm like, man, it just keeps happening with, with the portfolio I'm trading on the show, with some projects I'm working on kind of in the background. It's like, man, if you just wait until you're right, like things work out really, really well. And now there's a time and a place to adjust and be active and all those things. And so I'm not saying you shouldn't do that, but when it comes to your overall market bias, I think it's a mistake to constantly be kind of just changing with the winds and those kinds of things. So I say all that to kind of lay the groundwork to answer your question. Should you experiment with the call side? If you're delta neutral, then the answer would be yes. If you're not, then I don't think the answer is yes. I think the answer would be no. I don't know that it makes a lot of sense to do that because, as we've seen, the market can go up and it can stay up and it can keep going up and it can go up, higher than you think it should. It can go up higher than anyone thinks it should. I mean, I think we can all agree looking in hindsight that, okay, all-time high 4,800, that probably pushed up a little bit on the extreme. Of course, we all know that now looking back through the rearview mirror. But as it was happening, I mean, it was crazy. I mean, the market just, especially coming off of the pandemic and all, I mean, it's just crazy, crazy stuff. And so for me, it's kind of like, like you used the chess analogy, like really, really well. You had used the football analogy before, equally as effective. I'm going to throw a baseball analogy at you.
Oh, wow.
Right? Like if I'm a pitcher, right? If I'm a Pedro Martinez, let's say, and I'm in a tough spot and I'm in a spot where I really want to succeed. I'm in a spot where I really want to do my best. What am I going to do? I'm going to use my best pitch, right? So whether that's a fastball, whether that's a changeup, whether that's whatever, most professional pitchers, their best pitch is their fastball. So I get into a spot and I'm like, all right, if I'm going to get beat, I'm going to get beat with my fastball. And so again, being a perma bull, playing the bullish side of the market, playing the positive drift, playing the fact that the market goes higher over time. It's like, man, if I'm going to get beat, I want to get beat with that premise. I want to get beat on that hypothesis. I don't want to necessarily get beat because I tried to kind of, game the system and try to, discover, more gimmies than I have gotchas and try to, dance between raindrops by squeezing out a little more juice on the call side. I don't like that as much as potentially bolstering the downside if you wanted to experiment with this. But again, it all comes back to whatever your bias might be in the marketplace.
Yeah, Evan. Here, speaking of Evan, here's Evan.
Hey, Dr. Jim.
Hey, what's going on, man?
Not much. I'm really happy that we're able to have this conversation today. It's always really, really fun to kind of to pick people's brains who have some different experience than us. So I think it's good for all of us to be here and talking with you today. I think you hit on an interesting point though, about, experimenting with the call side if you're remaining delta neutral. And that's my main component of putting on the call side, is really just to balance my deltas. So I have a ratio of puts to calls on. I don't put them both on at the same time every day and expect that we're just going to stay right where we are. Like you said, there's the skew that makes things kind of difficult, but I've really just been using it to balance my deltas. So for me today, I'm sitting at about -2 deltas. I want to say I have 7 or 8 on the put side, and then 3 or 4 on the call side. So there's definitely not a one-to-one relationship there. But the whole reason I really started doing that was because I realized I could kind of eliminate that directional bias a little bit. It brings in more theta and doesn't use any more buying power. So for me, it was kind of a no-brainer. If I can layer these trades on and it reduces my directional exposure, why not give it a shot? And for me, I think it was a good spot to kind of start from. It was better for me to start doing this than somebody like Bobby, right, who's had 2, 3, 4 months worth of trades on. Because like he was saying, it was really hard to see the benefit of the call side when you have so many layered onto the put side. So I did just want to kind of interject there and let you know, it is a delta neutralizer, not a not like a greedy play, I guess you could say, right? I'm not expecting to bring in more theta, the market not to move. My 10 cents there.
No, that makes perfect sense. No, thanks for chiming in there, Evan. And yeah, I mean, it was so helpful for me to hear you not only chime in, given that you're kind of the brainchild of this strategy, but you're wanting to be more delta neutral. So something like that just makes so much more sense. It makes so much more sense. But listening to you also, and just trying to, just throw another hat in the ring for something to think about. I do think, this idea of expanding this strategy to the other side of the market where you're correct. You're not paying additional margin. You've already been margin on the puts, all those things. I'm thinking, all right, even if I'm not delta neutral, even if I do want to be a bit more bullish, could I potentially utilize this aspect, this new angle on the strategy? And I think the answer is yes, because, one thing that you shared that was really helpful is you've ratioed the two sides. Right. So this is kind of very much like a carrying the super trader type of thing, where you've got, double the puts relative to the calls, which you may not always maintain a 2-to-1 ratio, but you have some type of ratio in place. And so now I'm thinking like, okay, if I'm thinking about, okay, what are ways where I can lean more into time decay? What are ways where I can boost that theta a little bit? And I'm not necessarily having to get more bullish in doing that. Maybe I want to actually be a little bit less bullish. I don't necessarily have to turn in my perma bull card. Like I can still, tell everybody at my cocktail parties I'm a perma bull, but I'm selling calls on the upside that's further out. I've got that side of the whale in place. I don't know, man. That's pretty interesting. It's really, if we want to boil this down to something that's very simple that everybody that might be listening here today can definitely kind of latch onto, it's no different than a covered call. In a lot of ways, it's completely different than a covered call, but in the spirit of what you're doing, it's no different than a covered call. It's no different than having long shares and you're like, hey, I want to cap my upside in exchange for, higher probabilities and more premium. So I sell calls. This is just a more complicated and strategic way of doing that exact same thing. And so I like it, man. I do. I think it's an interesting way to potentially improve all those Greeks without any additional buying power. So yeah, so that's good.
That's a great analogy too, Dr. Jim, because, my head looked up to the left. I'm like, oh, covered call. It makes sense. It does. I see exactly how you're relating that. Here's another thing, Dr. Jim. I started doing these 1-1-1 trades back in August of 2021. So at that time, I had got lazy and was not recording my trades and recording this on the spreadsheet, just kind of got lazy. So I don't have the data from that. I guess I could recreate it and go through all the trades, but at this point, I'm not willing to do that. But we did start tracking these things in March. And the reason that we started tracking them is we were doing other strategies, some broken wing butterflies. We had got into some other things as well, and nothing was working in this bear market. And so the only thing that was working was these things. And I'm going, this is incredible. This thing is working well in a bear market. So I think it'll work well in a bull market with maybe a little bit, we'll trail the market a little bit, but with that downside protection, I think it's going to be fine. What I wanted to show you is this as well. And I'll show you those figures in just a little bit on kind of how we've done. But in Thinkorswim, we're able to group these trades into different, types of things. So here's the put debit spreads and here's the naked put component. Another thing that we're able to do here is you see all of these that are expiring today. And as you can tell, I have closed most of the short puts. And another thing that we're able to do is if we look at the 16 days, we can actually close a component, or we could close a component of these as well, right? Of the put debit spread to give us incredible protection. So if you look at the put debit spreads, you could close this, it's already at 99%. And like, say if I did something in this 16-day cycle, right? These are all put debit spreads. So if I close this one, it's already at a 98% profit. It gives me incredible protection by closing these. It gives me a little bit of buying power relief. It just beefs up what I'm able to do. So we can even start closing individual components of the put debit spread if our account beckons for us to do so by looking at our metrics. Oh, we're a little, using too much buying power. Well, taking off some of these naked puts and a put debit spread could give us relief. We could even say, okay, you want relief? Okay, go to our naked puts. Here's our naked puts. We could say, I've already closed all of those. So I don't have any expiring today, but here, we're at 96% profit. We could take these off and start, reducing our, so there's all different ways that we can, get our metrics back in line. I just want to bring that up to you.
Mhm. No, I'll tell you what, I absolutely love that. I love that because not only when you close, the short component of the put spread, do you get some buying power relief, but you're also going to now have, you're going to have clean delta on the way down, cleaner delta on the way down. So if you do get a big drop, right, your potential profitability will not be as capped as it was before because you're removing, that stopgap that's there. And so, I mean, that's really, really cool.
Look at this, Dr. Jim. For example, I've closed all my naked puts from this particular cycle. These are the trades that expire today, right? And you can say we've had this for quite some time. So this is a 5% drawdown or a 5% down move in the market. This is a 12% move in the market, right? But if the market were to go down, I mean, it's not going to happen. We've got circuit breakers, but it's kind of fun to play, right? Market goes down 20%. This is my 20% price slice. We're going to be up, $4,800 today. It's an incredible amount of protection. Again, this goes away today. The crash would have to happen today, but we've had this protection on for several days, of that downside protection. It's just kind of cool.
Mm-hmm. No, it's totally cool. No, I love this strategy, man. I really, really do. I think you guys have spent so much time in putting this together and, kind of working out the gimmies and the gotchas and all of those things. Again, it's, the biggest gotcha to this whole strategy remains the same as it really was a couple of months ago when I was first exposed to this idea. You just have to be okay at some level with the possibility that your size increases if those short puts get tagged. Like, the chess analogy gets even better. I'm sure you've thought of this, but just in case you haven't, it's no different than, your pawns are gone, your bishops are gone, right? I mean, the knights are gone, the rooks, they're all gone. I don't even play chess, and I know that's not good, right? All that's gone, and you're left with the king and the queen, and they've got to fend for themselves. And so you could very quickly, find yourself in a situation of kind of checkmate. And so that's obviously not good. You just have to be okay with understanding that, yes, this is a low probability environment. It's probably not, or a low probability event. It's probably not going to happen. But from time to time, it is going to happen. It's going to happen, or it's going to seem like it's about to happen, in terms of like the COVID crash, in terms of like December 2018, in terms of like October 2008, like things like that. Like these things are all part of a healthy functioning market. And so unfortunately, nobody knows when it's going to happen. So if we knew that, and if you guys figure that one out, you guys can let me know on my private number.
Dr. Jim, so we kind of compare ourselves to the S&P 500. I know that Tom doesn't like that a lot, but that's fine. We got to compare to something. So when we started recording these trades in this particular account, the S&P 500 was at 446. It's at 395 today. So the S&P performance is down 11%. We're up 3%. Now, I got to preface it by saying this. We're up 3%, but that was because during this same time, we were doing other trades as well that didn't work out. So we were doing the broken wing butterfly, we were doing everything. But this particular strategy in and of itself on a $100,000 account, if we were just taking this account, we've made $8,427.20 after commissions, which I think is dang good since we started this in March. We started keeping records on March 23rd. So to make $8,000 on a $100,000 account just on this is pretty good. I also wanted to show you this too, Dr. Jim. We got this set up over here, and this one, let's see.
I do have one question too while
Yeah,
you're bringing
yeah,
all that up. I meant to
sure.
ask this earlier actually. So you put on a new hedge every day, is that correct?
If the metrics allow it. So for example, in this account, I would go to this and I'll go, oh, I cannot, well, that's not it. I would go, I can't put on a trade
Because of your buying power limitations.
yes, it's red.
Got it.
So it gives me
Okay.
warning and tells me not to take additional risk today.
So, got it. Okay. So that's going to be the driver. Okay.
Now, if this
Okay.
were green, Dr. Jim, and everything's green, that is go ahead. I don't care about market direction. I don't care if market's down, up, sideways. We just put them on because the
Yeah, no,
probabilities
yeah,
are
yeah,
the
yeah.
probabilities.
So correct.
Yeah.
Do you ever measure, do you ever keep track of, because again, like the main risk in this strategy is, the royalty back there. It is the additional units that are back there, right? Do you ever measure like how large that has gotten as kind of an isolated event? Like that's separate from your overall buying power, just so you know, all right, in the event of a 10% down move, 15% down move, whatever, like this is what I have working. And do you have limits in place for how high you're willing to go on those numbers?
Yeah. So this is kind of cool too, Dr. Jim. So you can see we've certainly been tested during this bear market. We went up as high as 94.65% of buying power back in June, but we withstood that really, really well. So yeah, and here's what we do, Dr. Jim. So we do have a plan in place, right? We have a bunker plan. And what we call it is this: if we get tested on the naked put, if that put is tested and we have to go into the bunker, we have a problem children tab. So what we do is then we isolate the problem and we turn it into a winner by rolling out in time. So the initial trade brought in $51. I closed that naked put that we sold for, I guess this was 111. We sold it for what? $20. So we brought in $100. So this was a $400 loser, right, on that naked put. So then we sold the second one, right, and got an additional credit in excess of what we closed that one for. And this was the ending credit on the put debit spread. Look, the put debit spread, made us, we got a credit for closing that of $194. Then we actually did close the second put that we sold for $527 for $165. So we were able to take a losing trade and turn it into a winner. Our credits were bigger than our debit. So we've got bunker plans in place. If crap hits the fan, what do? Well, we know the first thing that we do on a huge down move, if we're like, we can buy a cheap put for a penny way out in time to give us a little buying power relief. We can sell futures or micro futures that will give us 50 delta short for each one that we sell to give us time to think. And then what we're going to do is we'll roll out anything in time and kind of put it into the problem child area. Let me show you another one. This is kind of cool, Dr. Jim. You like this one? This one we did in the IRA. It's a little more complete. So problem children here. This was a problem child, right? A 112 that we turned into a $721 winner when the naked put got tested. Here's one that we just went out for a break even, but we are extremely confident in our ability that if crap hits the fan, we're going to isolate the trades, we're going to roll them out in time, and we're going to, because now we may have to be rolling for 6 months, we may have to be rolling for a significant period of time, but we're pretty confident that we can make these things happen. Also want to say, Candy brought this up as well. We're also now implementing what we call a Sweet Bobby hedge. And the Sweet Bobby hedge is
Does that double as a barbecue sauce?
it does. It does. Sweet Bobby.
Yeah.
That's right. Sweet Bobby. But anyway, we'll go over that our next session, Dr. Jim, because I wanted to show
Yeah.
you, but I wanted to show you a little bit of what metrics that we're keeping up with. Now, keep in mind, in this count, this is like a $25,000 account. Our realized returns on this strategy, on a $25,000 account, we have made after commissions $4,262.94. We are the market during the time is down 8.84%. We're down 0.29%. But this is because we have lost money doing other strategies. This strategy is the only one we're keeping. So we would actually be up significant if we were just tracking this strategy. So now we're just tracking this strategy. So in March, we were doing other strategies. So let's say we had a profit of $190 there. We're still running other strategies. We lost $325, we lost $850, we lost $1,300. We still got other strategies going. Now around in this time is when we're going to start implementing just the 111, right? Now here's what we want. I want to kind of basically hide all of this for just a second. I want you to focus on this. Here was the month where we started saying, hey, let's take these things to expiration, because you're going to love this, Dr. Jim. So we had total theta of the month of $1,296. So in other words, I took all of our daily theta. I've written a formula that estimates our weekend theta, right? So we had theta for the month of October of 1296, total theta. Our profit and loss as reflected in our net lick. So you can't go by these because we weren't doing it this way. This is when we changed. We were able to keep 107% of our daily theta in profit. So we were like, oh my gosh, this is great, right? So even though, you know, Tasty says over time, we're probably going to keep 25% of the premium that we're selling. We're like, I think I can increase this number significantly with protection to the downside. So that we ended up making 5.46%, market did 7.99%. You know, so we're tracking this, and really October is the month where it changed. So far this month, we're keeping 40.83%, you know, but we're just keeping those metrics as well. We've also got.
So you think the reason for the big differential in terms of your outperformance of theta capture is it can almost entirely be attributed to the 111.
And taking it closer to expiration.
Yeah. That's cool, man. That's really cool.
Taking it closer
That's
to
awesome.
expiration. So let's go to this little thing. We call this the weekly premium tab. This is kind of a cool little thing that keeps up. You can see some of our metrics that we track here. So our premium capture on closed trades is 52%. Now, why is that low? Because we were doing these things separately. Now we're doing them. I mean, we were doing them together as the entire thing. We anticipate our premium capture is going to increase significantly. Our projected yearly profit, $4,400. Our projected yearly return based on what we've done is 16%. We anticipate that's going to go up as we now are collecting more of that premium from those naked components. We have a projected weekly profit at the current capture rate of $85. We have sold premium of $8,100. We have profits of $4,300. So that's that 52% that we've kept. Our average days in the trade are 21. Every time we put on a trade, we're collecting about $56 in credit on our average trade. There's our, let's see, 16%. Our win rate is 91, and we have a positive expectancy for every trade that we put on in this count of $41.
That's every trade, including the hedges, or
that's everything. Yes, in the 111. Yes. And the put debit spread, yes, everything.
Okay,
so
cool.
It just basically says, hey, of all these trades, what's your average expectancy on all of these? And so now what we've done, Dr. Jim, is instead of tracking these trades, and you say we started here, right, on March 14th, green means they were closed profitably. red means they were closed for a loss. And over here, you can see the profit and loss. So we had a $523 winner, but as you see, we've lost $305. Let's zoom into that so you can see it better. Yeah, here we go. So, but you see the profits of when we were doing them together, far outnumber the number of losing trades. We lost $262. But then we decided to go, let's start recording these separately. So we've only had a few here, but here's all of our open trades now. So we actually record the naked component separately from the put debit spread.
Yeah, that's really, really interesting. I mean, this spreadsheet is phenomenal. And the data that you guys are collecting, it's second to none. I don't know that I've seen anything like this when it comes to the trading world. And so I'm very impressed by this. One thing, I have to run here in just a couple of minutes.
Sure.
But one thing that just popped into my head that I want to just share with you guys. So you guys had mentioned the idea of potentially calendarizing the hedge where the put spread is a shorter duration, the naked puts are longer duration. I'm the more I let that kind of simmer on the back burner there, I'm more and more intrigued by that. One of the problems that I see is there's going to be so one of the problems that I see is, let's say you pay $10 for the put spread in 30 days and you have the naked puts in 60 days, right? I know that you may go to 90 days, whatever, but just to keep it simple, 30 days and 60 days. If I pay $10 for 30 days and I have the naked puts at 60 days, so let's say the 30 days go by, the put spread expires. Now the question becomes, what do I do? Because now I have a naked put that's uncovered in some regard. I don't have anything coming in against it. I now have to pay more, right? Another debit of some amount. So you would have to start to tinker with the amount. So maybe it's not $10 anymore in 30 days. Maybe it's only $7 or $6.50, so that you leave some additional cash to pay for the put spread in the second 30 days to fit with the second half of the naked puts life. And so, but I am intrigued by moving further along in the maturation process of that put spread, so that maybe you don't start off as a pawn, maybe you start off as a bishop instead of, kind of starting at square one. So I'm very intrigued by that though. But I would think about that. Yeah.
That's a great point. And maybe we can even collect more premium because we're farther out in time. We can go further down in price and collect the same premium that we would do if we were doing them all in the same expiration. So maybe we could, take in more premium on the nakeds further out in time to kind of compensate for that as well.
That's right. Yeah, that's right. Yeah.
So Dr. Jim, I want to say this, you guys should follow Dr. Jim on Twitter. I follow him on Twitter, and I told him this week that I spent way too much time looking at his butt because he was doing some exercise, and I'm like, I'm not sure that's how I want to spend my day. But Doc, I'll say this, your fitness and all that you do is really, really good. I came from a point in my life a couple of years ago that I started this group because I was thinking I needed to teach my wife how to trade because I was eat up with the diabetes. I had a toe amputation. You know about the toe stuff with the injury that you've had. So I am actually 9 toes Bobby. So I've already got that. But what I did though is I was so inspired by tracking of trades that I'm now tracking my food intake. I'm going to the gym 5 days a week. I go to the doctor today. I've gone off all insulins without his knowledge. I can't wait to tell him, instead of me taking 6 shots of insulin a day, that I haven't had it in over, probably about 5 weeks, that it's really inspiring to see you in the gym. And I'm going to the gym. I'm watching you every day. And it's really inspiring to me. And it's really helping me to get things in line, not only with trading, Dr. Jim, but in fitness, health, and life as well. So I want to say I appreciate your influence there.
And I appreciate you, man. Thank you very much. I'm very humbled by that. And I mean, great work by you, man. I mean, what an unbelievable turnaround for you. And that's just that. I mean, that inspires me. Like, that gets me fired up. And so to hear kind of your story a little bit, and, I'm not surprised. I'm not surprised that tracking your food and your training and stuff had such a positive impact on you, because I think that almost always happens, and people don't want to do it for all the reasons that, you know, are obvious. Like, I don't want to invest the time, blah, 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 blah. But when you actually do it, it's not too different from what you're doing with options and trading and hedges and stuff. You start to see things, you recognize patterns, you pick up on things that you would not otherwise see. And so that's cool, man. I appreciate you very much. Yeah, I just, thank you, Bobby. Appreciate that.
Well, Dr. Jim, can you tell everybody how to get in touch with you? I know you got to go, so just kind of tell you how they can, you know, keep up with you, what promote your show. Yeah, I think you'll probably be on with Errol today, right?
Yep. Yep. That's right.
Wednesday.
Yeah. So, I mean, yeah. So with Tasty Trade, I mean, I'm on every day at 2:00 from theory to practice, you know, Monday, Tuesday, Thursday, and Friday, 2 to 2:45. And we're YouTube live every Thursday. So you can watch us on the YouTube channel there, but we usually do another YouTube live another day a week. And then I have today's assignment with Errol today. We're 2:45. So I guess it's not 2:00 every day. It's 2:00 Monday, Tuesday, Thursday, Friday, and then 2:45 on Wednesday. And then, yeah, if you want to connect on Twitter, that'd be amazing. Like, I'm very active on Twitter, even more active now that Elon's taken over, because I think it's even more fun. But
Yeah,
at
it's more
J-
fun. It's like, hey, we can talk, we can, you know, it's just, it seems wide
it's way
open.
more fun. It's
Oh,
way
it
more
is.
fun.
It
And,
is.
and honestly, I mean, obviously the political side of things is a whole separate thing, but just from a content creator standpoint, I'm very excited to see what he's going to do, because I think he's going to start to do some things that will rival YouTube and Instagram and all that stuff. So I'm, as a content creator myself, I'm very excited at the opportunities coming on down the chutes. But if anybody wants to, oh, Candy, thank you so much. Candy put my handle there right in the chat. It's just at JSchultzF3. If you guys want to connect on Twitter, I would be forever humbled by that, and we'll have a good time. Every
and
once
Doc-
in a while
yeah.
to start off your morning, you may see a Dr. Jim glute shot. It may happen. So just be ready. You have to know what you're signing up for, as I say on the show all the time.
But I don't understand why you're in there with socks and Crocs and not these other type shoes, Dr. Jim. I'm like, I'm worried my toe would get crushed. I'm worried about your toe a little bit.
I'll tell you what. So, I mean, just for an extra 30 seconds. Yes. So I've got squat shoes. I've got training shoes. I've got all that stuff. But I learned from the Squat University guy on YouTube, Dr. Aaron Hershog or something like that. He is incredible. And one of his claim to fames and one of his big stickler things is the shoes that most companies make these days. They squish your toes in way more than they ever should be squished in. And our feet are designed where the toes are supposed to spread out. And so training barefoot, training in slippers, whatever, is so much better. Well, anyway, I have some kind of torn tendon in my calf or something. And I think wearing shoes most of my life has exacerbated that problem, because once I got rid of my shoes and I don't wear them 95% of the time now when I'm training, my calf feels so much better. And I think it's largely because I'm allowing my foot and my ankle to actually move in the range of motion it was designed to move in. And so that's why I'm kind of sold on the foot thing. But yes, I mean, you know, for every gimme, there's a gotcha. And so the gotcha is I got to be careful with my little toesies that they don't get any weights dropped on them. So, yeah.
Hey, Dr. Jim, I want to go ahead and tell you this. I'll reach out and contact you as well. But my investments class at the University of Alabama starts January 11th. So it's going to be an entirely online class. And I would love to get you to schedule a session with you to speak to these guys in our class. You know, here they are in college. They're trying to become financial planners. So we're teaching them investments. And I think it's good that they hear about people and taking risk, and you know, we're really opening them up to options trading, futures trading, things of that nature. And I just got a email from one of the other professors in the college. She says, "You won't believe this." She said, "My students who took your class last semester, they're talking about protective puts." She said, "It's never happened since I've been teaching at Alabama." And I thought that's just, I was thrilled to hear that.
No, that's awesome. Yeah, reach out to me. Let's get it set up. I would absolutely love to do that. And I will go out of my way to do that, because I really, really miss my time in the classroom. So I would love to be able to connect to all your students. But hey, I see everybody in the chat saying thank you. I mean, Candy, Stacy, Gerardo, Gary, you know, John, DJ, David. I mean, John, Ed K, Mark. I mean, I appreciate you guys, man. Matt, Jolly, and then Ramka there. Thank you guys. I appreciate you guys being here. And if I can ever help anyway, just let me know. And Trey, my handle on Instagram is the same as Twitter. And so yeah, so there you go.
Ladies and gentlemen, It's Dr. Jim. Thanks, Dr. Jim. We'll see you later.
Awesome. Thank you guys. We'll talk soon. Okay, bye.